So, I wanted to talk about why I use futures versus options. There was a, I started in options, and Naked, for the most part, Naked puts in calls and with a stop loss. And, it was cool. It was a momentum breakout trend strategy. And it worked until it didn't. Like the fake outs sometimes got to me to where it would be really frustrating when I would hit a fake out and it would reverse on me and it would count as a loss. And options are expensive. Like they're so expensive to where like sometimes they feel unattainable for certain companies. Like Adobe was up there. I think it's cheaper now, but it was something that I didn't like. It's just how unattainable buying contracts were, and the whole time frame aspect. Ultimately you want to buy something like a leap, but I don't know. I just didn't like the uh, the whole structure. You got to know the option chain, open interest. Make sure there's enough open interest if you wanted to sell your contract just in case, and the I don't know profit convexity of just the contract if it were to move us to a certain price. To me, when I think of options, I think that they're good when you have your own money to play with, or you're given income and you kind of don't know what to do with it, and you want to actually put it at risk, and you don't want to put it in an investment, but you want to try to trade it and use some leverage. To me, like options are really ideal during the time when I think we're in the green zone. So the green zone is a reference to some research I've done to the Eurodollar futures, and I'm referring to a part in the cycle. So this cycle is 22 years long, and a good reference point is 1991 to 2013. And trading swings specifically, I think options are really good for swing trading. And trading swings is really easy in the green zone. I have some traders that work with me at the hospital, and they do options, and they said how trading is really easy, was easy, and now trading is hard because the market has changed. And I think it's just a different period in the whole like debt credit cycle for um, the foundation of what makes the market, which is credit and debt. Eurodollar futures is part of the credit and debt cycle because it's just as good as cash, basically. Um, the Eurodollar futures, and it's what I akin to the long-term debt cycle by Ray Dalio when he refers to the long-term debt cycle, and what comes to mind is the Eurodollar futures, and I'm specifically saying that in the green zone, I think options are good to do because it's a good time for swing trades. And as long as you're able to get a really good entry for a swing, it makes sense to do options, especially with your own money. So that's one thing I like about options. But with futures is a whole different animal. You can do one or two things. So instead of like putting long for or put and call on the options chain, and that's it. Or you could do sell. You could sell a put or sell a call for some income. Yeah, that's a little bit more advanced. And then there's covered calls. Covered calls make a lot of sense when there's a lot of volatility, but when there's a lot of volatility, it makes trading harder. So I almost don't like covered calls in some way, just because of that aspect where you can't really harvest the risk premium. Is the covered calls, the amount you would get back goes up when the risk premium goes up, but the thing is the only thing that makes the risk premium go up is when it's volatile, and it's ideal when it's ideal for covered calls. So covered calls is weird, and then the whole income strategy of selling credit and debit spreads. I don't know. I belonged to a group where they would do some advanced strategies like, I don't know, iron condor, or I don't know, butterflies, or strangles and straddles, and I don't know. It seemed kind of cool at first, but then I was just like, this is stupid. Like, it's just complex, and it's like all these different strategies, and knowing when to implement them. And it just seemed like it was more of something that I was conditioned to like versus actually liking it because of there was some drawbacks. The drawbacks is that options, I don't know. You can do day trading with options, but for the most part, I feel like they're mostly a swings. Like they're made for swings, and instead, like what I've come to like. So, options are good for swings. That's just the first no. I mean, I started in options. So I made swings. Best time for swings. Oop, come on. Is in the green zone of the 22-year euro dollar futures cycle, and each green zone lasts 5 to 6 years. And starting for reference in 1991 and ending in 2013, you could calculate the next cycle, and you could calculate the green zone for the next cycle, which is it's 2034, and then 2034 plus 5 or 6 would end in 2040, which would begin the next fragility cycle, the fragility zone of the cycle. And which comes to why I do futures is that futures in. So one problem I had with options is that it was hard to calculate risk because I had to like multiply. So I had to figure out, okay, how much were the contracts, and then with the contracts, how do I calculate to where I can get a 50% stop loss, and then go from there. And usually I could only do one thing. I could only do a swing, and the goal was to get like 2 to 1, or I tried to get a 5 to 1. The problem was I couldn't do a scalp and a swing. I could only do a swing, and if I tried to shoot for a scalp like a day trade, then the profit would be for the most part small. It wouldn't be as big as compared to if I would get a swing. So options played with my emotions weird to where you would make some weird decisions, like for instance, you would FOMO into a swing, but then the swing doesn't work out and you get stopped out or at break even, or and you didn't take profit, and you wish you could have taken profit. And then vice versa, if you went scalp and you did a day trade, you could have you took profit and you got some profit, but then the price went farther than you anticipated, and you FOMO, and you're like, man, I wish I just stayed in the trade and or knew more that I could stay in the trade. I don't like that game. I like to have a scalp and a swing at the same time, and with futures or a CFD, they're levered so high to where you can make that possible, where you could do both at the same time, and at the same time, you could actually calculate risk management easier. Like with a CFD, you would just do a pending order with kind of what you're thinking as a possible, you know, like to figure out the sizing issue, because for the most part, once you figure out the sizing of how many lots in a CFD would equal 1%, you could figure that out, and then with the stop loss that you have, and then you could do some interesting automation where you do a trailing stop loss, or you could have automated entries in a CFD. So the pros for the CFD and the futures, because the CFD and the futures are very similar. CFD is contract for difference. CFD, I can have a lot of automation, and I can have access to prop firms, and I could do a swing and a scalp at the same time. So I could have multiple strategies. So there's all these edges that kind of stack up to where, it makes it obvious, once you experience it. Like it's a little difficult of a learning curve to begin it, but once you begin it, you have access to these other tools to where you can make your equity curve a lot more stable compared to just always shooting for home run swings. And that's kind of what I equate swings to, is like home runs. And you get in that kind of mindset of home runs, and it makes it more volatile in the equity curve, because home runs, they're a little more difficult to get to stick, and you kind of need more of a lower volatility in the market and a more stable market. And we identified when that would be, but it just kind of goes to show the period of when options make sense to where they would stick versus when they wouldn't. And I don't, even with futures and how you can control the risk management, trading in something that's really volatile is sometimes not even beneficial for futures, just because it's just so hard to trade. And what's cool with the futures, you get to see the volume footprint. You don't really get to see that with TradingView or any kind of charting platform. But going back, so CFD and futures, they allow me, pros and cons, they basically allow me to trade a scalp or a day trade in a swing, like a 5-to-1 or 10-to-1 risk to reward at the same time, due to the leverage. So what I'm basically saying is that there's more leverage in futures because you can do smaller position sizing, and you could do multiple strategies at once. And you could also at the same time control your risk better than you can in trading options. Now, when options are good, they're good, but how often does that happen? That's kind of just the probability. There are no certainties; they're only probabilities. So, what is that probability? Is kind of what I'm questioning for options. Is what percentage of when you do options is it actually good? And if you were to make it increase the quality of when it's good. That's kind of why I moved to futures and CFD, is because you could increase the quality, because you could increase the quality of your risk management, and thus you could also increase the quality of when it's good. And that is just the base argument of why I switched from options to futures. Is because of all the things I mentioned. I could do a scalp and a swing at the same time. I could know the position risk per trade at any given time. It's pretty much the same because it's measured in pips or ticks, depending on if I'm doing a CFD or futures. And it's easy to calculate. It's a little easier to keep track of. I don't have to do things on the fly. With options, it's more of a manual entry. So that's another thing I don't like about options, is that it's more robotic and manual. I guess more manual, not robotic, and more emotions get involved when it's more manual. It could cloud assessment, and it could cloud FOMO of just entries. When it comes to futures and options, I can automate some of it. Not only do I have access to prop firms that could give me funding, like on a CFD or futures, where I could just pretty much scale my profitability just by passing an evaluation. Not only that, like I could also, what's it called? I'm losing my train of thought because it's early morning. Now, like a scale, I can have automation, and with bots, trade bots, like strategies is what a bot in NinjaTrader, and then an expert advisor is a bot in MetaTrader 4. And I could automate my entries. I can automate the trailing stop loss and most of the process so that I don't have to be there fully trying to engage with the market. That's good because when you start engaging with the market and you start to get that rush, time gets altered and you end up devoting a whole bunch of time to it. And the goal is to just find that balance to where you increase it with efficiency to where you're not giving that as much time. But I pretty much gave the best kind of time period when options would be efficient, so you don't give a lot of time. But trading options when it's super volatile, trying to catch tops and bottoms makes it more difficult to have a positive equity curve without massive swings of drawdown and home run profits. Which would balance out. But those kind of things make it hard to discern just kind of what the real net is, the net profit. And then the last thing, so I talked about prop firms, I talked about automation, as far as like edges in CFD and futures, and then there is one note about CFDs. They're banned in the United States. But banned doesn't mean like they're illegal. They're just no one would recommend them to you, and you have a higher chance of just being conned by an unscrupulous broker. And the whole goal is to be on the inside club on knowing who to trust. So if you get good at the game of finding out who to trust in the game, then you're good. And for the most part, the ones I use is FX Choice. So they did, after 2020, stop allowing U.S. citizens to have accounts with them. So I got in the club, but for other people, it's they're not able to get in the club anymore with FX Choice. So that option is pretty much off the table. And then one that's kind of up in the air. I'm not sure if I like, but it works. I mean, I've gotten money in and out of it. It's Osprey FX. But those are the two CFD brokers that I use that I pretty much don't try to venture out of just because of just the weird kind of ethics that happen in CFDs and stories that I've heard. So I try to just keep it tight on just who I trust. And then what's cool is if you get with a trustworthy, what's it called, prop firm, you don't have to worry about the broker. Basically, you just need, and then trustworthy prop firms. There's one in Dallas, Texas called E8 Funding, E8 Trader Funding, and I've heard good things about them. There's there's Top Step, which I've heard good things about, and then there's like MTT, I think that's what it's called. MTT. No, that's not it. MT. It's basically. If I go here, market structured trader. And then he has a section for prop firm. Here it is. My Forex Funds, that's what it is. And then Apex is the one I use for NinjaTrader. And I think there's other prop firms for NinjaTrader, but I like the I like Apex. I think Apex is the best for NinjaTrader as far as I know. And then for CFD, the ones I mentioned, I like. I think Top Step is more for NinjaTrader, and then E8 Trader Funding, and then whatever that one was, My Forex Funds for the CFD. And so what's cool about the prop firms is that, here we go, automation of entries and exits. Easier to calculate risk management, so that's why is that underline? And then the scalability with prop firms. So what's cool with prop firms is like I could have access to, if I don't have any cash, that's like the hardest part on just building. Now, if I get a prop firm and I pass, let's say, six, eval accounts, one thing is that the evaluation of the prop firms actually make you a better trader. So it just teaches you risk management better. It pretty much makes things to where you have to be a better planner and think things out more because you are trying to access other people's money. And because of that, they have a higher standard. The higher standard will force you to be more strict on your risk management. And because you'll be more strict on your risk management, you'll look at things closer. You'll try to see you'll focus on the equity curve and growing that in a really methodical manner. And so that's one reason why the prop firms are really good. It's because the evaluation process actually makes you a better trader. And then once you pass the evaluation, you would have access to live funds or not live funds, but they would pay you on the profits that you would make on a withdrawal for the profits they would make on the rebills. It doesn't matter as long as you make the profit right. And then eventually you want to force them to have to follow your trades because you're making so much money. But the scalability with prop firms is that if you are able to tap into a lot of funds, the next year you could double your scalability. So if you grow enough to where you're sustainable and you figured out a way to manage your risk and you're growing, you could double the growth for the next year and treat it kind of like they say like a business. But for the most part, I just think of it as just trading. Trading is a business, but for the most part, let's just think of it as trading. I just find it really weird thinking of trading like a business, but it pretty much is because it has a profit and a loss, and it has periods of seasons where it does well and it doesn't. So it's similar to a business, but it's not really business. And then when you're with a prop firm, you're working as a contractor, so it's kind of a business and kind of not. With the business, it's got scalability and automation to where you could be an investor versus versus an owner, to where you could step away from the business and it could run and you wouldn't have to be there. And that's somewhat untrue with trading, depending on how you do it. But with trading, you at least have to show up to be able to put in the entries, or at least make sure your analysis is sound for actually allowing the bot to execute. But the scalability with the prop firm or the evaluation accounts is real. Like it's pretty much the same risk for all accounts because you'll just do by percentage risk on the total accounts, and which with each win that you do that gets put into the account as profit, the profits scale because it's percentage based, and you would just add accounts and then keep the risk percentage the same. The risks will stay small, but the gains will be big. And with every year, you can add more accounts and you would get more income. And that's the idea with that. And then maybe with all those accounts and the income that I get from that, I could put that I could wait for the green zone to do options, and then, I don't know, have a huge stockpile to invest, and then I would wait for a huge recession. But that's kind of just what I think I would do, just on a very like surface level. Why I like futures versus in options, futures in CFD versus options. And I don't know, there's a lot of people that love options, and they say that their edge is from options. I've encountered that in some Discord groups, but I just not in love with options anymore. I don't know. I just don't like it. And I like having access to currencies as well, even though for the most part I don't know understand them. I don't trade them. I only trade the S&P 500. But I would like to trade currencies just because I can have access to other markets in different times, like the London session, or having maybe trading the indexes like the DAX or the FTSE during the London session, and then trading the S&P 500 during the New York session. But for the most part, um, I don't like options. It's my least favorite thing to trade. And then the second least favorite thing to trade is just regular stock shares. Like, I don't know. For the most part, I'm trading my um, retirement account uh, in and out of cash into the S&P 500 just out of necessity for maximizing the growth of it. And right now it's in cash. But with us being in the fragility zone in the cycle, like when anytime there's a downturn, I get out, and then whenever the downturn happens, I get back in, and the goal is just to have an efficient growth, low drawdown, uh, kind of growth in the retirement account to where it's a faster growth. Where I don't have compounding losses on holding. And I mean, there is a joke with investors, which is, what do you call a trader that holds a losing trade? They're called an investor. So there's a little bit of a running joke with that, but for the most part, eventually, I want to get to where I'm storing cash. So for the most part, I will say this: like most of the wealthy, affluent are investors, whether it's Warren Buffett or you go to the Forbes, richest. For those who have like private equity or just who started a business, that had massive growth like Amazon or Facebook, Netflix, Google, all that, they are investors. Most of their wealth is invested in their company, and you can't break away from that logic for the most part. You're gonna have to force to become an investor. You're gonna be forced to having to hold long, but at the same time, it's it's you don't have to uh, focus on that a whole lot because like investing is pretty passive, but and you can make it a little more sophisticated. But for the most part, the whole goal would be to get it to where I can increase the amount of money going into my retirement account, uh, if not allow 100%, and then to have it in cash until for stockpiling until it's time to deploy it at a low, and the whole goal would be to increase it as fast as possible. And that's it. And when you have like trading knowledge, you're able to do that more efficiently as opposed to a buy and hold investor. But at the same time, for the most part, you're going to have to be a buy and hold when it comes to shares or just a retirement account, like in general. So it makes it like the most easiest thing to trade because it's that you would only make a move maybe once a year or maybe twice a year or once every other year or once every 4 years. It's kind of just like the degree of just how often you would have to touch it. You wouldn't have to touch it that much. But when it comes to like something where you do swing trading and day trading, you have to be more active. But that's pretty much it.